Every time conflict flares up in the Middle East, you probably notice something strange happening at the gas pump within days. Prices creep up, sometimes sharply. But why does a war thousands of miles away hit your wallet almost immediately? That's exactly what we're going to break down today. Let's start with the big picture. The Middle East sits on roughly half of the world's proven oil reserves. Countries like Saudi Arabia, Iraq, Iran, Kuwait, and the UAE are among the largest oil producers on the planet. When that region becomes unstable, the entire global energy market holds its breath. It doesn't matter where you live, in Ohio, Ontario, or Oslo, you are connected to Middle Eastern oil, whether you realize it or not. Now here's the first thing to understand. Oil prices don't just react to actual disruptions, they react to fear of disruptions. This is what traders and analysts call a risk premium. The moment a serious conflict breaks out, or even looks like it might, oil traders around the world start pricing in the possibility that supply could be interrupted. Futures contracts, which are basically bets on what oil will cost in the coming weeks and months, spike almost instantly. And because those contracts influence what refineries pay for crude, the effect travels down the chain to your local gas station faster than most people expect. Let's look at some real historical examples to see how this plays out in practice. During the Gulf War in 1990, when Iraq invaded Kuwait, oil prices nearly doubled in a matter of months. Kuwait was a major producer, and Iraq's seizure of its oil fields sent shockwaves through the market. The United States and a coalition of nations eventually intervened, and once it became clear that Saudi Arabian oil fields were not going to be captured, prices started to come back down. But during that window of maximum uncertainty, prices surged dramatically. Fast forward to 2019, drone strikes hit two major Saudi Aramco oil processing facilities in Abqaiq and Khurais. That single event temporarily knocked out about 5% of the entire world's daily oil supply. According to reports at the time, oil prices jumped by roughly 15% in a single day, one of the largest single-day spikes in history. The facilities were repaired relatively quickly, and prices settled back down within weeks. But that event showed just how fragile the system can be and how fast the market reacts. So what are the specific choke points that make the Middle East so critical? There are a few key geographic locations that matter enormously. The Strait of Hormuz is probably the most important. This narrow waterway between Iran and Oman is the passage through which roughly 20% of all the world's traded oil flows every single day. If that strait were closed or even seriously threatened, the impact on global supply would be enormous. Iran has repeatedly threatened to close the strait during periods of heightened tension, and every time that rhetoric heats up, oil prices respond accordingly. Another major choke point is the Suez Canal and the Sumed pipeline in Egypt. A significant portion of oil moving from the Persian Gulf to Europe and North America travels through this corridor. You might remember the headlines in 2021 when a container ship called the Ever Given got stuck in the Suez Canal for 6 days. That single blockage disrupted billions of dollars in trade and reminded the world how dependent global commerce is on these narrow passages. Now imagine that kind of disruption caused intentionally during a war. It's also worth understanding who the major players are in terms of oil production within the conflict zones. Iran is a significant producer and exporter, and any conflict involving Iran directly, or any expansion of sanctions against it, tends to restrict Iranian oil from reaching the market, tightening global supply. Iraq, despite years of instability, has become one of OPEC's largest producers. Libya, which has experienced years of civil conflict, has repeatedly had its oil output disrupted because of fighting near or around its oil fields and export terminals. Each of these countries represents a potential supply shock waiting to happen. Now, let's talk about something that often gets overlooked: OPEC's role during a crisis. OPEC, the Organization of the Petroleum Exporting Countries, and its broader alliance known as OPEC+, which includes Russia, have the ability to increase or decrease production to influence prices. In theory, if a conflict disrupts supply from one member, other members could pump more to compensate. Saudi Arabia, in particular, holds significant spare capacity that it can deploy relatively quickly. However, whether OPEC chooses to do that depends heavily on politics, existing agreements, and its own economic interests at the time. During some past conflicts, member nations have stepped up output to stabilize the market.
In others, they have held back, allowing prices to rise. There's also a longer-term dimension worth considering. Prolonged conflicts don't just spike prices temporarily, they can reshape the energy landscape for years. The wars in Iraq and Libya contributed to sustained periods of uncertainty that discouraged investment in new production. When oil companies are not sure whether a region will be stable enough to safely operate in, they pull back on exploration and development spending. That reduced investment can create supply shortages years down the road, even after the conflict itself has ended. On the other side of the equation, high oil prices during conflicts have sometimes accelerated the adoption of alternatives.
The oil shocks of the 1970s, which were tied to political conflicts and the Arab oil embargo, are widely credited with jump-starting serious research into fuel efficiency, renewable energy, and energy independence policies in the United States and Europe. In a similar way, prolonged price spikes today can speed up the transition toward electric vehicles and domestic energy production, which gradually reduces dependence on Middle Eastern oil over time. So what does all of this mean for the average person watching the news and wondering whether to fill up their gas tank today or wait? The honest answer is that short-term predictions in oil markets are notoriously unreliable, even for professional traders. What history does tell us is that the initial spike is often sharper than the long-term reality justifies, because fear gets priced in quickly, but then fades as the actual situation becomes clearer. If a conflict does not result in a major physical disruption to oil infrastructure or shipping lanes, prices tend to pull back after the initial surge. The factors that really determine whether a price spike lasts are things like how close the fighting gets to actual oil fields or export terminals, whether key shipping routes are genuinely threatened, how quickly OPEC responds with additional supply, and how strong global demand is at the time. A war in a remote part of a country with little oil infrastructure may cause a brief spike and then fade quickly. A direct attack on Saudi Arabia's core production facilities or a genuine closure of the Strait of Hormuz would be a different story entirely. What you should keep watching for in any Middle East conflict is reporting on those specific choke points. Is there any threat to the Strait of Hormuz? Are oil fields or pipelines being targeted? Are major producers pulling back on output or exports? Those are the signals that separate a short-term fear-driven spike from a genuine sustained supply disruption. The bottom line is this: oil and geopolitics have been intertwined for over a century, and that relationship is not going away anytime soon. Understanding why prices move the way they do doesn't just help you make sense of your energy bills, it gives you a clearer picture of how the global economy actually works. If you found this breakdown useful, make sure you subscribe and hit the notification bell so you never miss our daily news and explainer videos. We put out one new video every single day, and we keep it clear, factual, and easy to follow. See you tomorrow.